Hi, welcome to the podcast for Chapter 16. This chapter deals with the management of working capital. And our first podcast, I'm calling this Working Capital Basics. So we're going to kind of define some terms and some different areas we're going to look at throughout this chapter. So working capital is generally defined as the assets and liabilities required to operate the business on a day-to-day basis. So what they tend to be is our current assets and current liabilities, if you recall that from your accounting background. And so you can see cash, receivables, inventory, accrued liabilities, accounts payable, things of that nature. Gross working capital represents an investment in our operating assets. So the term working comes from short-term day-to-day operations, and capital, the funds needed to support those assets. So that's where the term working capital comes from. Working capital requires these funds. We have to sort of maintain our working capital balances because we have, to provide for our operations, we just always have needs for that type of funding. We'll talk more about short-term liabilities, this idea of spontaneous financing, in the next podcast. But just to let you know, as we are doing our operating activities of a business, we are creating payables and accruals, which are basically debt. And so as these things sort of spontaneously arise, they're going to offset the funding required to support the current assets. So not all of our capital can go to our current assets. Some of it will be reduced by the requirements of our current liabilities. So net working capital, then, is the difference between the gross working capital and the spontaneous financing. So gross working capital is generally our current assets, and our net working capital then is our current assets minus our current liabilities. And that is really the definition. If you've done anything with working capital before, we've always defined it as current assets minus current liabilities. So if you ever hear people talk about working capital, what they're really referring to is net working capital, which again is the difference between the two. Okay, so working capital management is an important part of running a business. The goal of management then is to run a firm by tying up as little money as possible in the current accounts. So that means strong inventory management, and we'll have a podcast in this chapter where we talk about inventory management. Cash and receivables management, and we'll have a podcast in which we talk about that. And then payables and accruals, and we have a podcast in which we focus on that as well. Again, a lot of terms in this. So the cash conversion cycle, let me mention this to you in case you see this on a quiz or something. The cash conversion cycle is really how long does it take us to go from cash back to cash. And so in this case, if we have cash, we're going to spend it on inventory, or if we're a manufacturer, parts inventory and labor. Either way, we're going to do that to produce an item or purchase an item that we can sell. That then creates an accounts receivable, and we later collect that from our customer. So we now have cash to start this cycle over again. And this is important for businesses, because if businesses can speed up the cash conversion cycle, that helps improve working capital management. Permanent and temporary working capital. We might have different needs, working capital needs, based on, it might vary with sales levels. For example, temporary working capital supports seasonal peaks in business. You can imagine for a second that like a company like Toys R Us has different inventory needs during the Christmas holiday season than it would during other times of the year. So the permanent level of working capital is what we need to support our sort of constant minimum level of sales. So perhaps again Toys R Us has a permanent level that they need, but then at certain times of year, I don't know, Christmas, Easter maybe, I don't know, can't think of other times, but they might need additional working capital to support that, and we call that temporary working capital. So you can see a little bit that here, right? So we have this permanent working capital, and then on top of that there might be some seasonal needs. This is an important concept. Short-term working capital should be financed with short-term sources. We call this the maturity matching principle, and the idea is that the term of the financing should match the duration of the project or the item that is supported. So what companies are trying to avoid is going out and taking out a long-term loan to be able to pay payroll on time. That is it's not illegal to do that, but that is a business that might have trouble staying in business. So if we have payroll requirements, we want to use short-term funding to meet those. Let's look at some differences between long-term financing and short-term financing. Long-term financing is safe. The funds are committed. They can't be withdrawn, but usually long-term financing has higher rates. Short-term financing, it's cheap but has more risk to it. The short-term rates are usually lower. It's risky though, because you're always in the marketplace looking for borrowing. And I don't know how many of you are familiar with like mortgages, but here's a good example, right? The interest rate on a 30-year mortgage is almost always higher than the interest rate on a 15-year mortgage. Now, we wouldn't call a 15-year mortgage short-term, but it's still an example to highlight those differences. Alternative financing policy. A mix of short and long-term financing supports working capital. If we use a lot of long-term sources to do that, that is a more conservative approach. If we're using a lot of short-term funding options, then that is a more aggressive approach. And so you can see what a lot of companies do is kind of a mix of these. So maybe a good part of our permanent working capital and fixed assets are supported by long-term financing, and perhaps seasonal or temporary working capital is supported with short-term financing. And it looks like the same slide. Okay. So the working capital policy, this again, remember we're talking about how we manage our working capital. So it refers to the policies and issues that a company face. How much working capital is used, how much of it is used to supported by short-term or long-term financing, what's the nature and source of any short-term financing used, and how is each component of our working capital managed. This is the policy that we want to think about and establish when we talk about managing working capital. All right, that concludes the podcast dealing with working capital basics.